Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome back to the 118th episode of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Good morning, Mark. It's great to have you back, buddy. Beginning of Q4.
Yeah, sorry about that. It's wedding season right now, so had to go to a couple of weddings actually last weekend, so that were not in Dayton. So
yep. Well, I missed
fun. You. Yeah. Well, I missed you too.
Nick was a great guest. I think we had a wonderful podcast 117 last week.
I said it about Aaron. I'll say it about Nick. People might start wanting them on more than me.
And me.
Might get replaced.
And me.
Might both get replaced.
Got to give the people what they want.
That's right. So before we begin, as always, I just want to take a first few minutes to recap the performance for the month and the year of the major indexes that we track. And these numbers are as of the market close on October 4th. So not a whole lot of data for the month, but we'll give you what we have so far. S&P 500 index is virtually flat for the month of October and up 14.5% for the year. The Dow up 0.33% for the month and up 10.95% for the year. The NASDAQ Composite Index down 5.6% for the month and up 12.1% for the year. The IWM ETF that tracks the Russell 2000 Index up 0.7% for the month and up 12.3% for the year. The Vanguard International ETF ex United States down 0.8% for the month and up 4.3% for the year. 3-month T-bill yield is 0.04%, 2-year Treasury is yielding 0.28%, and the 10-year Treasury yield sitting at 1.46%. Moving on to news, headlines, and current events from the week, Matt. Congress and the Biden administration still do not have an agreement on the debt ceiling, which the Treasury Department warned it would run out of money by October 18th. I feel like this is a common thing every year, and it's like gotten to the point where it's like the boy who cried wolf. Like, people keep making a huge deal about this every single year, and nothing seems to come of it because they just extend it. They eventually come to an agreement, and we go on as life is normal.
Yeah, I mean, last week into the podcast, Mark, Nick was reporting that they had an agreement that pushed it out, kicked the can till December 3rd. And I joked with him, I'm like, oh, perfect. So what do you think everyone's going to be talking about around the Thanksgiving dinner table, right? And then that didn't happen. You know, do I think they're going to come to some agreement before the 18th? I do. But obviously this political posturing is not good for the markets short term.
Yeah. But I do think it provides a quote-unquote excuse for some market volatility that we haven't seen in a while, and in my opinion, possibly could provide a decent buying opportunity if people are waiting for a pullback.
Yeah.
Marvell Technology CEO said that the chip shortage could potentially last through 2022, and Marvell is a semiconductor company.
Yeah.
So this doesn't surprise me. I mean, I guess if people haven't already realized it, you know, we are so dependent on semiconductors in our technological age right now that pretty much virtually everything that we use has chips in it, right? And, you know, the demand for all this stuff is sky high, and with the supply constraints, you know, people haven't been able to get the necessary chips that they need, and prices have gone up. I will point out that Barron's over the weekend or last week, I think you sent it to me
over
and
the weekend.
Nick. Their cover story was the supply constraints and the cargo ships all over, you know, sitting out in the sea waiting to come to land. Might signal that supply constraints could be getting better coming up here.
Yeah, you know, I like to use those front page headlines on publications like Barron's, Mark, as the top or bottom in a specific topic or trend. And, you know, usually when it hits the cover of Barron's, usually it's baked in, priced in, you're at a peak.
Right.
So we'll see if the Barron's cover, headline continues to be the top or bottom.
Right, exactly. And I think, if you go back and look at it, like back in 07 and 08, when they had the front page of, the housing crash and that things were doom and gloom and never going to get better, it was like within that week, like the market bottomed or something, right?
Yeah.
So just interesting to see. On Monday, OPEC and the ministers ratified the 400,000 barrel a day output increase scheduled for November to combat the highest oil prices that we've seen since 2014. And can you just give people just a little taste of, what OPEC is if they don't know who OPEC is?
So listeners, OPEC is a consortium of a lot of oil producing countries that this organization was very powerful in the 70s, 80s, and 90s before really oil production in Russia and the U.S. became more and more. And so this is mainly Middle Eastern countries and a few others that come together and make joint decisions on mainly the output, how much they're going to produce of oil. Mm-hmm. And so what they're attempting to do is they're being very opportunistic, and they're going to produce more. I think it's in their best interest because the old saying is, what's the cure for high oil prices? Higher oil prices.
Yeah.
Because what happens is you get more capital investments, and eventually the supply becomes greater because the investment break even makes sense at that point.
Right.
So I think this is them trying to slow down these price increases that we're seeing. And now again, you're seeing people travel. You're seeing a lot of Jet A fuel being used. Ultimately, I do think there's going to be some demand there. And I think the U.S. here, we're going to have to start producing more.
Yeah, good point. Last but not least, U.S. factory orders climbed 1.2% in August as projected after increases of 0.7% in July and 1.5% in June. And this is a fourth straight monthly gain in orders and 15th gain in the last 16 months.
That's not bearish.
No, it's a good sign. Moving on to tweets, articles, and research from the week. The first thing that caught my eye came from a blog post written by Morgan Housel titled "A Number from Today and a Story About Tomorrow." And this kind of goes back, Mac, to your topic 2 weeks ago when you talked about stocks not making sense from a valuation and academic standpoint.
Yes, sir.
So I just wanted to read a couple of things from this. He said, every forecast takes a number from today and multiplies it by a story about tomorrow. Investment valuations, economic outlooks, political forecasts, they all follow that formula. Something we know multiplied by a story we like. The trick when forecasting is realizing that's what you're doing. And we're going to start to see forecasts for 2022, I'm sure, at the tail end of the fourth quarter here come out. So just keep that in mind. We're going to see that. But
I'll throw this out there. Most were very low compared to where the market's at today.
Yeah, I agree.
For this year. So they were way off.
The hard thing is that while the number we know today can be something real and verified, the story we multiply it by is driven by what you want to believe or what will make the most sense. Forecasters get into trouble when the number we know from today gives us an impression that you're being objective and data-driven when the story about tomorrow is subject to opinion. When valuing a company, revenue, cash flow, profits is the number we know. The earnings multiple you attach to that figure is just a story about future growth. So that's like one of the things that, that I want to point out is that when people see all these like analyst forecast, they're coming up with that multiple on what they think it's going to be. And I'm sure that they have, several calculations, but it is really just a forecast, right? It's not, you can't look at something and be like, this is what it's going to be, right? So he wraps up and says, same with economic trends. We have lots of data, but none of it means much until you attach a story to it about what you think it means and what you think people will do with it next. This is called investing.
Yeah.
So I just think that that's how markets work. It's the company multiplied by the story that people want to believe. We've talked about this several times before, but if you have a good CEO who's the founder of a company and that can tell a good story, they get people to buy into that story, whether it's true or not.
Yes.
So, you just got to keep that in mind. And, it's hard to keep your own bias out of it, right? Because if you believe so much in company XYZ, you're not going to look at the negative side of it or what are the potential risks to this company.
Yeah. In addition, Mark, I'd say that a lot of those shareholders that follow those types of leaders, they have stronger hands. And so when you have weakness in the market, they're less apt to sell because they believe in that person. Mm-hmm. Use the football analogy. If your team's down and you really believe in your quarterback, you're going to have faith that they're going to pull it off. Mm-hmm. And I think it's no different in the investment world with the CEOs. When you have weakness in the markets, I'm going to hold that stock because I believe in what he or she has been doing and what their future is.
Right. Yeah. And he said it perfectly. That's what's called investing. The next one was a blog post written by Ben Carlson titled, "Why U.S. Housing Prices Aren't as Crazy as You May Think." And this one was kind of caught me off guard because I guess why would I pay attention to housing prices in other areas but the U.S.? But this was kind of interesting. He says, the housing market continues to set new records. The S&P CoreLogic Case-Shiller U.S. National Home Price Index just reported its highest one-year gain in history, up nearly 19% through the end of June. These gains are obviously abnormal and can't last forever. However, I remain firmly entrenched in the camp that this is not another housing bubble. There are structural and market forces that are causing these price gains, even if it all feels out of hand. You have household formation among the biggest demographic, millennials, generationally low interest rates, constrained supply from lack of home building following the housing crash, and a pandemic that induced people to buy. But there's another reason the housing market isn't as crazy as you think. Housing prices in the rest of the developed world have outpaced U.S. prices for some time now. The Dallas Federal Reserve has housing data going back to 1975 for developed markets around the globe. These are the price gains for Australia, Canada, France, the United Kingdom, and the United States. This works out to annual appreciation rates of 7.6%, 7.4%, 6.3%, and 5.7% for Australia, the UK, Canada, and France, respectively. Housing price gains in the U.S. look quaint by a comparison of just 4.6% per year. And if people go to our show notes on Twitter at Jessup Wealth or Facebook, Jessup Wealth Management, or on LinkedIn at Jessup Wealth Management, you'll be able to see these charts in this article. And I think this does it better justice than by me just telling you the stats here. He says, of course, there are differences in these markets by population, demographics, cities, housing availability, economics, interest rates, etc. It's hard to make an apples to apples comparison. Perhaps the best way to level the playing field is to look at these gains on an inflation adjusted basis. On a real basis, the gains in the U.S. housing market look even more muted than they've been in these other countries. And it just goes to show, real housing prices from 1975 to 2021. In that time period, Australia's are up 324%, the UK up 279%, Canada up 278%, France up 179%, and the US up just 99%.
Wow.
On an inflation-adjusted basis.
Wow. That includes the high inflationary period in the late 70s and early 80s.
It does. It does.
All right.
So he says, maybe housing price gains in the U.S. make more sense when you consider them on a relative basis. Does the U.S. really look like a crazy speculative bubble when compared to these other housing markets? What if we still have some more catching up to do? Just throwing it out there.
Interesting take.
So I think it's a really interesting take because, again, I think everyone's pounding the table on, we're going to have a market crash in housing. And eventually our prices are going to come down. Yeah, but who's to say when that's going to be?
Now, I remember back in, 05, 06, 07, they were building like drunken sailors. Mm-hmm. And you're just not seeing the starts, the new building like you did back then, especially at the cost of these raw materials right now. And so with that being said, I do think that, supply is going to be constrained for some time.
I'm grinning just because I'm going to mention that in my next article.
Unbelievable. Unbelievable.
If anyone wants someone who's going to tell you what's happened, they should come talk to you. You're like a mind reader.
I had no idea you were going to talk about that.
So staying on the housing topic, the next one is from Ben Carlson again, titled The Death of the Starter Home.
This is hilarious.
It's kind of funny. Home builders aren't making new houses that sell for $200,000 or under anymore. Thus, the starter home is dead. At first glance, it would be hard to argue with this conclusion. After looking under the hood, my conclusion is somewhat more mixed. New home sales at $200,000 and under were as high as 60% of total new houses sold in 2002. In July of this year, that cohort accounted for just 2% of new home sales. New homes of $500,000 and up were just 3% of sales in 2002, but nearly 30% of sales in June of this year. There's an obvious trend of new homes being built at higher price points. There are a few explanations for this trend. For one, there were simply more houses being built back then. This number is finally creeping higher, but is still well below the early 2000s boom. The higher price point for new homes is also being driven by the experience home builders had following the housing market crash. Builders went overboard in the housing bubble and were left holding the bag. And he says there's still lingering scars. And I think this is true. This is something that people aren't talking about a lot, but home builders remember what happened back then, and they're going to be ultra conservative going forward with this.
Even in this craziness, you rarely see a spec home.
Yeah.
Rarely see a spec home.
Yeah. And, when I was going through the new mortgage process for our new house, I was frustrated with the process. I was like, I felt like I was in a good financial position compared to a lot of other people applying for mortgages, and they still wanted my arm and my left pinky toe off my foot.
And daily blood draws.
Yeah. But then, after calming down and taking my emotion out of it, I'm like, I get it. People that had, low 600 credit scores were getting $1 million homes back then.
With no income verification.
Right. With, debt to income levels that were stupid. So I understand why it is the way it is. You just got to take the emotion out of it when you're going through that process yourself.
Yeah. I had this conversation a couple of months ago with a local home builder in the Dayton area. And we talked about how, the lower end homes, price points were just not being built in our area. And I proposed that there needs to be some sort of private and public partnership where, for example, you take some of these areas in the city of Dayton where they've demolished homes and now you just have land, that they go in and it's like a joint venture between a builder and the city. They do a whole street at a time. They provide down payment assistance, and you really start developing these entry-level homes again. And it was an interesting conversation. I don't know. It was just something I think that needs to happen.
Yeah, well, I think it's good that, this article is, it's related to our local area as well.
Yeah.
It's not just big cities.
Yeah.
It makes sense that home builders have moved up to higher price point homes that have better margins and buyers with higher credit scores. The $200,000 to $400,000 range of new home sales averaged 35% of the total in 2002. So far in 2021, it's more like 54%. Unfortunately, for new home buyers, that might be the updated threshold for a new build. There's also a huge factor in play that we simply can't ignore in this equation: mortgage rates. The average 30-year fixed mortgage rate in 2002 was 6.5%. This year, the average is 2.9%. This makes an enormous difference in monthly payments.
Could you imagine people getting a 6.5% mortgage in today and what the attitude would be about that?
Oh my God, people would freak out.
Yes, they would. I remember people that were getting VAs in 2000 because you get a lower rate and it was 7% and that was considered a good rate.
Yeah, that's crazy. Just, 20 years later.
Yeah.
Right?
Yep.
Monthly payments are almost 35% lower at today's interest rate levels versus the rates in 2002. Of course, prices are going to be higher. So this is really interesting. Rates have allowed buyers to move up their price points. Yes, taxes and down payments are higher too, but lower mortgage rates have allowed home buyers to build pricier homes with little to no inflation in their monthly payments. People can afford more home at today's rates. The monthly payment for a $400,000 house is now lower than the monthly payment for a $300,000 house in 2002. If we take this to the extreme, the monthly payment for $1 million home is now $520 lower than the monthly payment for a $750,000 home in 2002.
And that's definitely adding to it.
Yeah, that's adding to it. And again, we've talked about this before, but this has been a massive cause of this. Just when people have, the ability to borrow money at cheaper rates, they can afford more expensive things, right?
Yep.
So there's a whole chart on this too, if you want to go check out this article on our show notes as well. This doesn't necessarily mean the starter home is dead. It just means those looking for a new starter home at lower prices are going to have to adjust their expectations, and they're likely going to be buying an existing home rather than a new build.
Louis not happy about that.
No, he's not happy about that. So I don't know. I just thought that was really interesting because there's so many factors at play here. But when you look at this on an objective basis, this all makes sense. And, I know people are going nuts with, how they think housing prices are way overvalued, but just reading that article and reading the data, it kind of makes sense to people why things are the way they are right now.
Yeah, and I was talking to one of our clients last night, Mark, and they were bidding on a property. There were 3 competing bids, and they felt they had to come in at over asking. So that's still happening right now as of yesterday.
Yeah. I talked to a client yesterday too. Same thing.
They
had 8 offers within a 3-hour period or
still
something
happening.
Like that. All cash.
Still happening.
Yep.
Yep.
Crazy. I'll turn it over to you.
I got some good ones this week. I know.
You always have some good ones.
I'm locked and loaded.
Still waiting for you to tell me you have a bad one.
I'm locked and loaded. Okay? All right, listeners. First one I have is seasonality stats from top-down charts. Now, this note is from October 3rd, Mark. So for September, the S&P 500 index posted a return of negative 4.65%. Let's just face it. It was not a good September. Now, why was it down? You could sit there and blame market worries such as Evergrande, the debt ceiling, tax hikes, the Fed taper, rising yields, etc., etc., etc.
And that's why it's just at least for me, all I need to know is that the market was down 4.65%. Doesn't really matter why.
Yes, correct.
It is what it is. It was down 4.6%.
So one thing that stands out at me is top-down charts in their research note has monthly stats for the S&P 500 index going back to 1964. Okay, Mark? Now, it shows that for the month of October, the average return is 0.9%. The average for November is 1.4%. And the average for December is 1.3%. But here's the thing I want to throw out there. October has the largest standard deviation and the most kind of movement. So the worst October in history was negative 22%, and the best was positive 16%. So, historically, listeners, October is a more volatile month, up and down.
Well, that was what was Black Monday was in October, wasn't it?
It was, sir.
Yeah, okay.
So again, it's nice to see how, these numbers, we're going to be going into this seasonally strong period when you look at history.
Yeah.
Now, you have any other comments on this? Because I got another one here.
No.
Okay. So my next point is I have a big surprise about flows, meaning money going into or out of stocks and bonds. Now, this is going to be data that is from also top-down charts from their October 3rd research note. There's going to be a chart in our show notes, Mark, that is from the Investment Company Institute. It goes back to 2009, and it shows the flows from exchange traded funds and mutual funds into bond specific investments, into stock specific investments. I was surprised. Okay. So what this chart indicates is that still the money going into bonds is continuing to go up, and stock, ETF, and mutual funds is very muted, very muted. And I'm curious, Mark, about your opinion about this, because what do you think is going to happen when the Fed eventually does raise rates? People have not really experienced a multi-year bear market in bonds in well over a decade. They're not used to losing money in bonds.
Yeah.
And with all this money that's been flowing into bond funds, especially by this chart the last 3 or 4 years, I think people are in for a rude awakening.
Well, yeah, I think that if you're a bond, or excuse me, if you're in the camp that interest rates are going to go up over the next couple of years, then it doesn't make a whole lot of sense to own bonds right now because, there's that inverse relationship. So if people are buying now at bonds, locking in an interest rate for the next however many 2, 5, 10 years, and interest rates go up, then your bond isn't going to be worth as much as new bonds issued at the higher interest rates, right? So they're going to dump that and then go out, and that's a process that I don't want to get into today. But yeah, and it goes to show you that flows are not directly correlated with performance.
That's a great point.
Over the long term.
Great point. I just think that, I think there's a perception in the market that these two are flipped. That all the money's flowing into stock, ETFs, and mutual funds and not as much into bonds. And when you look at the raw data, it's not telling you that.
No. Nope.
I found it very interesting. Now, I got something for you. An update on the IPO market. Now, before I continue, Mark, explain to listeners, what is an IPO?
So IPO stands for Initial Public Offering, and that's when you have a private company that the general public hasn't been able to invest to, goes public, trades on a stock exchange, and the general public can buy shares of that company or buy ownership of that company. So, the big ones over the past 2 decades have been, Facebook going public, Google. So, when companies are started, when they're startups, it's a private company, right?
Yep.
And the general public doesn't have access to that. But, once they start trading on an exchange, then, anyone in America can go out and buy shares of that company.
There you go. Thank you, sir. So there was a post I saw on Twitter, and it's from Bullish Rippers is the name of the Twitter handle.
You do pick good tweets with big good Twitter names. That's for sure.
Thank you.
Bullish Rippers.
Bullish Rippers. So his tweet was, a lot of big IPOs are expected to list soon. And he shows a list of what they are. Ready for this? Companies like Stripe with a proposed $100 billion valuation. Things like Instacart with a $39 billion valuation. We're talking things like Impossible Foods, $10 billion. Chime Financial, $30 billion. Plaid, $13 billion. NerdWallet, $5 billion.
Wow.
Better.com, $8 billion. Fresh Market, $1 billion. Reddit, $15 billion, and so forth. Why am I highlighting this? This is not bearish. If you're going to bring to market such large entities, they wouldn't be coming into the market if the market was bad. And coming off of a poor September like we saw, and this is on the horizon, this is not bearish.
Yeah, it's interesting because I think we, before, I can't remember exactly what it was, but was it like right around COVID where you had a bunch of those companies go public?
Oh, yeah.
Was that the last time that we had like a big IPO boom?
Oh, yeah.
And look what the market did. It went nuts.
Yeah.
I'm not saying that's the reason it did, but just the timing is a little suspect.
The reason I just bring it up, in my opinion, and again, I think the IPO market is a good barometer of risk appetite in the market, and you don't have this much in the queue and be bearish on the market. My 2 cents.
Yeah, that's interesting. Yeah, over the next quarter and early 2022, it looks like.
A lot of names.
Yeah.
So I'll send it back to you for the financial planning topic of the week.
Yeah. So this one was written by Roxanne Alexander, who's a CFP, and it's titled, "Should I Buy or Lease a Car?" And I feel like this is always a really hot topic, and people have their really strong opinions on this. And for example, my dad will go to his grave arguing the point that you should always buy a car and not lease it. It's just like one of his like principles, and he'll argue with you to the day you die about it, right? I feel like this is one of those that's like you're either on one side or the other, and there's no in between.
Okay, I can't wait for this one. It's gonna be great.
So
would have been even better if we had Jerry on this section
good.
As well.
Yeah, I'll have to ask see if his opinion changed this weekend at my brother's wedding.
I will ask him myself as well.
So she said, should you buy your next car, new or used? I made a rough calculation a few years ago, and the conclusion was whether you bought or leased the exact same car, you would likely break even at about the 3-year mark. Before that point, you may spend less on a lease, but after that, you'd tend to come out ahead by buying. Why? Because the lease payments take into account the big depreciation hit you experience with any car, which is highest in the first 2 to 3 years. If you lease, you are still paying for the depreciation. Before I move on, can you just explain to people what depreciation is?
Yes. So if you were to buy a car, the minute you pull off that lot, the difference is what someone else is going to be willing to pay for that car. Mm-hmm. And since they didn't get it brand spanking new with
no miles.
10 miles on it, you tend to walk away with at least down 10, 15% the minute you pull off that lot. Mm-hmm. And then as you put miles on there, you're competing with new cars at that point, the first couple of years. And so that's where you, as your article's indicating, the peak or the majority of the depreciation will come in the first 3 years.
Right. And she says, for example, if you buy a car with $50,000 cash, after 3 years, you will be able to sell it for, say, $30,000, which means you spent $20,000 owning the car for those 3 years. If you lease the car, your 3 years worth of lease payments will likely be very close to the same $20,000 due to the depreciation factor, which Matt just explained. If you buy and keep the car longer than that, it continues to depreciate, but at a declining rate over time. So owning the same car for 6 years is then cheaper than leasing for 6 years. The break-even point is around 3 years. So one way to save is to buy a 2 to 3 year old car that has already taken the initial depreciation hit, keep it for 7 to 10 years, and hope the repairs are not expensive. That makes sense to me. What else to consider? Do you want to pay cash or finance? I don't want to beat a dead horse here, and I think people know our stance on that. But if you have $50,000 sitting in cash earning 1%, but your loan would be at 6%, it may make sense to pay cash. If the $50,000 is all you have in emergency savings, you may not want to tie up funds in a depreciating asset and prefer to go the finance route, especially if you're still working. If your $50,000 is invested in the equity market, and you expect a 7% return or more over time, you may prefer to finance and leave your money to grow. Another important aspect for retired clients, and this is big, is if your money is all in an IRA or other retirement accounts, taking out a $50,000 lump sum to buy a car may actually be a $70,000 withdrawal once you factor in taxes, and may push you into a higher tax bracket for that year.
And could affect your Medicare.
Yep. Yeah, your Medicare premiums, right? Mm-hmm. Again, this is just a great point that usually is not brought up. But, in my opinion, at today's low interest rates, financing could save retirees on taxes.
Agreed.
Just throwing it out there.
Agreed.
Maintenance and depreciation costs. If you're buying a car, you want to check into what is covered under the warranty and for how long. Anything not covered would be your responsibility as a extra expense. Another point to consider is that if you have an accident with your car you own, when you try to resell it, you're going to get a lower value for it. Some insurance policies offer coverage for this possibility. Before choosing a car, check out resale values for the type of car, so when you're ready to sell, you will have an idea on the future valuation. In order to get a sense of how much a car costs, TrueCar.com or Edmunds.com are great tools. TrueCar aggregates all the new or used cars in the area based upon your factors you determine: make, year, model, color, etc. Moving on to leasing, lease commitments. If you tend to keep cars for a long time, purchasing may be the way. If you tend to keep cars for a long time, purchasing may be the way to go. But if a shiny new toy every few years is your thing, you might want to look into leasing. If you believe your circumstances may change, such as a new baby on the way, elderly parents coming to live with you, or a future move from a summer climate to a winter climate, leasing provides more flexibility since you are not committed to the car for more than 4 years. There is usually an upfront cost to leasing, which is an amount due at signing. This lump sum usually reduces your monthly payments and may be required depending on your credit. Some dealers offer zero down, but all this does is increase your monthly payments. It's all a numbers game. A higher down payment means lower monthly payments and vice versa, just like anything else in life.
Yep.
And again, this gets into more than just, I think, the financial decision behind this, because there's some people that really, really, really like getting a new car every 2 to 3 years. And if that's something that's important to you, then go ahead and lease it. Even if it doesn't make total financial sense, then go ahead and do it.
Sometimes it doesn't have to.
No, that's right. That's right. And that's one of the things, again, with what we try to discuss on this podcast, is that not everything has to make sense. You know, I think too many people are so focused on what retirement's going to look like for them that they forget to still enjoy themselves now.
Yeah, the post about ignoring that $4 cup of coffee affecting your retirement is ludicrous to me.
Yeah, and that's going away, I think.
Yeah.
Some brands have scheduled maintenance included, which can be quite convenient. However, there are also several coverages such as tire protection and dent and scratch insurance that you can buy that will increase your lease payment. Most standard leases offer $10,000 mile limits per year. If you drive more than 10,000 miles, this will also increase your payments on the front end, or on the back end. When you return the car, you'll be required to pay for the extra miles, which I had to do once.
Yes.
So if you drive more than 15,000 miles annually, purchasing a car may be cheaper for you. And if you are driving 25,000 miles a year, this can get restrictive and expensive. Keep in mind, even on a purchased car, the increased mileage will fetch you a lower sales price when you are ready to sell. So again, if you're someone that's going to struggle to stay under that $10,000 or even $12,000 range, you got to consider buying, I think.
You talk about the mileage.
Yeah, the mileage, because you pay for that overage.
Correct.
Right?
Correct. And it can be sizable, like 25 cents, 30 cents a mile. It can get pricey.
Yeah, exactly. There are some companies' websites that will allow you to lease a car on a month-to-month basis, which may be beneficial depending on your circumstance. If you have to terminate your lease early, Swap-A-Lease is a useful website that I have used several times in the past and found very efficient. However, not all car brands are supported. And I can personally say I've used Swap-A-Lease in the past, and I have nothing but good things to say about it. Minimal headaches, pretty easy transferring the lease. I think I got a car that was shipped up from Florida, and then, I think it was from Florida. But again, if you're in a pinch and you just need something to get you by for the next 3, 4, 5 months,
sure,
it's a really good website that's relatively affordable.
Sure.
To make that happen. So I did that, and I would totally recommend if people are in a position where they need a short-term lease to do it.
Yeah.
Or if you're still trying to figure out
what you want.
You
want to drive something for a while.
Right. Or if your lease is up and you want to get the car that's coming out in 6 months,
but you need something.
But you need something until then go ahead and do this. But I would encourage people to get on this a couple of months before your lease is actually
It takes some time.
over. I did not do that, so I learned from this mistake. So don't wait to the last minute to do this, because it does take time to transfer the lease.
Yeah.
Lastly, if you own your own business and can use lease payments or mileage allowance as a tax write-off, this may be another factor to consider.
So I got a viewpoint.
Okay.
I'm going to share this with Jerry too on this weekend. And again, for listeners, Jerry is Mark's father. 20 years ago, it was a hassle to sell a car. You either had to post it in the newspaper and do a private transaction, or you had to go to a dealership and do the whole trade-in dance. Okay? And I think back then, Mark, it was easier for people to lease a car, turn it back in, and just get whatever else they wanted. Mm-hmm. You fast forward 2 decades, you now have these entities like Carvana, CarMax, where you don't have to buy anything from them, and they'll give you a relatively fair price for the car.
Yeah.
And you're in and out sometimes in less than 30 minutes.
Yeah, and I've heard stories that, they look up, people look up what the value is on, Kelley Blue Book or TrueCar or whatever, and then they have Carvana come out and look at it and give them a price, and sometimes it's pretty dang close.
It sure
for
is.
the ease.
For the ease.
They come and pick it up. You don't have to take it anywhere.
So I'm going to argue, and this is what my household has switched to. We now buy exclusively. Mm-hmm. Because the convenience of if we wanted to sell is so prevalent now. And I think that the money you're getting for the car is very fair, that the need to lease, at least for my household, is no longer there.
Yeah, and you can put a price tag on convenience, right?
You can. And I think that is why I would argue a lot of people, like myself, in the 2000s were leasing rather than buying. And now with a lot of these technology and a lot of these newer companies offering fair prices, I don't see the need to lease anymore.
Yeah, I agree.
Just giving you my 2 cents. And we'll see what Jerry has to say about this.
Yeah, I'll see.
I'll report back at the end of next week's podcast.
That's all that we had on the agenda today. So anything else before we wrap up for the week?
Listeners and viewers, we are going to be entering Q3 earnings season. And what that means is the middle and end of October, a bulk of publicly traded companies are going to be informing their shareholders about their earnings for the third quarter for July, August, and September. And it'll be very interesting to see if that starts to change the narrative in the market.
Yeah, I agree. Okay. Thanks, everyone, for tuning in to episode 118 of the Independent Advisors Podcast. We will see you all back here next week. Hope you have a great weekend.
Thanks, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.